Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's April the 6th, 2016. So we just finished the first quarter of 2016, and it really was quite the quarter. And I'm going to just give you some of the highlights in terms of the changes in prices during the quarter. So let's think about the TSX. The TSX finished up during the quarter about 3.7%. And that's after being down quite a bit in the early part of the quarter. But overall, we finished up about 3.7%. The S&P 500 hardly budged during the quarter in terms of the beginning and ending numbers and finished up about 0.8%, although early in the quarter it was down about 10%. So some major swings during the quarter in terms of the market indexes. When you think of the Canadian dollar, I mean, after a complete shellacking last year, our Canadian dollar during the quarter was actually up 6.9%. And so we began the quarter around 72 cents and finished about 77 cents. But most of you will realize that in January, we actually touched 68 cents, just a little bit below 68 cents. So when you think of the kind of swings during the quarter, it's quite phenomenal. In terms of energy and oil, which is so important to the Canadian economy, we saw energy prices stabilize, and during the quarter, they actually were up about 3.5%. The big performer during the quarter was gold, which was up 16.6%. After having a number of weak years, we would expect gold to be well positioned for the long term, given the debt crisis that we really are surrounded by, and we'll talk a little bit more about that in a second, but gold was really the outlier, along with silver, which performed quite well, also being up about 9%. In terms of the Rocklinc portfolios, we had strong numbers across our portfolio, especially relative to the market indexes, and we saw overall in our portfolios the first 3 months we were up about 3% across portfolios, and we've been compounding about 7% plus over the last 3 years per year, and that's with about 60 to 65% invested. So we're looking at our overall book of business. In terms of equities, we've been compounding low double digits per year over the last 3 years. So we're fairly pleased with that, but particularly given our conservative positioning as a company. Now, we just are finishing up our first quarter report, and I've called it the economics of impoverishment. And we just highlight again some of the issues that we are really concerned about, and in particular, negative interest rates, which continue to envelop more and more of the world's economy, more of the world's GDP, if you will. So before I get to the negative interest rates, let me just make a couple of comments. First of all, globally, debt continues to grow. We've talked about this. Since the debt crisis in 2008, 2009, we've piled on globally 60 trillion plus in debt. I mean, there's been no slowdown in debt. If you look at the numbers, just big picture, we're adding $8 trillion a year US in debt at least, and that does not include unfunded liabilities. And that's on a base of about an $80 trillion economy, that world economy that's growing maybe 2%. So if you think about that, we're adding at least $3 plus in debt for every dollar of growth. And I mean, you don't have to be a mathematician or a rocket scientist to realize that that's not sustainable. And so this is a massive concern to us as investors. We're seeing, as I said, very little growth around the world, and that's largely because of this stranglehold of debt and aging populations and governments that are just getting bigger and bigger and more bloated, and this is a big concern to us. Canada, thinking of our own country, Canada, our new Prime Minister says Canada's back, and absolutely, we're back. We're back as leaders in debt. We're just having a debt binge in this country, and so this is very concerning to us as investors and as Canadians, and this should be concerning to every Canadian, and especially Canadian investors. Our federal government is telling us that they're going to be adding $113 billion in new debt over the next 4 years. But you have to realize that we've already been on a debt binge for some time in Canada. Over the last 8 years, we've added over the last 8 years, we've gone from about 830 billion in debt up to about 1.3 trillion this year. So we've already been adding at 6% a year to our debt. And so this is clearly unsustainable. And much of this, as I think most of you are aware, as we've talked about, is provincial debt. So over 60% of the increasing debt in Canada has been provincial. And our federal government has been trying to rein that in, but now we're going to have a federal government that's just going to have a party and leverage up the Canadian balance sheet. So this is very, very concerning. And so we're watching this with great interest and also with tremendous caution. Our servicing of debt now in Canada, our cost to service the debt is now well over 60 billion, and that's at low interest rates. And so we're putting as much into servicing our debt as every single dollar across the country that goes into public education, from kindergarten, junior kindergarten, right through grade 12. So we have a debt problem. It has been masked by low interest rates, and now that we're faced with a federal government that's just going to open the spigots and spend, we're very concerned. So that gets us to the issue of negative interest rates. In our view, the fact that the world is pursuing negative interest rates tells us that the overall economy, the global economy, is very, very sick. And we need to be really, really careful. In fact, if you think about it, the negative interest rates now, there's about $8 to $9 trillion worth of government bonds that are trading at negative rates. That means if you buy them, you're going to get back less when they mature. We've got over 33% of the world's GDP involved in countries that have policies with their central banks of negative interest rates on the short end of the yield curve. Okay, so we've also got a report out from JP Morgan, one of their top economists, saying that negative rates could reach, and again, this is just an economist speaking, so we have to take it with a grain of salt, but they're looking at the terrible growth prospects going forward. They're saying negative rates in Europe could actually reach negative 4%. In Japan, negative 3%. And in the US, we could see negative 1 or 2%. I mean, these are shocking numbers if we were to try to go down that road. We don't think that this is a sustainable road in any way, shape, or form, and we need to be very, very careful and vigilant. So what are some of the implications if we do try this to continue pursuing this road of negative interest rates? Well, number one, there'll be very, very low rates of return on all sorts of investments. This will put huge pressure on pensions, annuities, life insurance companies. Big problems if this continues. Second, why would companies make long-term investments if there's negative interest rates? I mean, if you're going to discount the future with negative interest rates, it makes no sense to make long-term investments. And we think we're already seeing this in corporate behavior, corporate action. There's not a lot of growth. Companies are not willing to take the risk to set aside capital and invest it in the future. Negative rates will only exacerbate that problem. Third, we're hollowing out the middle class. The middle class, which is dependent on interest income and being able to save some money for a rainy day and for their future and for retirement, is not able to do that. They're not able to do that because rates are low, and if they were to go negative, it would be a tax on capital, which is just complete insanity in a capitalist system. But also they're paying way too much for overvalued real estate, and so their mortgage debt is way too high. As you hollow out the middle class, the government continues to get bigger and take over more and more of the economy. And so what you're seeing is, with negative interest rates and low interest rates on the horizon, the government's programs are getting larger and larger. There's more bloated spending and more corruption in terms of the government spend. And this is going to be, again, have serious implications for a lot of Canadians in the middle class and their ability to generate wealth over time. The government is not going to create jobs, sustainable jobs. The government does not create sustainable wealth. It taxes wealth and it's going to interfere with long-term growth. So these are big concerns that we have in terms of our investment philosophy. And so we talk about this in the report. We're going to go into much more detail, so you'll see that in the report in about a week's time, and we encourage you to read that and to sort of bone up on some of the things that are taking place all around us so that we can be educated in terms of the economic insanity, really, that is enveloping the world of finance as a result of this debt crisis. Lastly, what do? What are we doing? As we said to you before, look, we're buying hard assets. We're buying businesses with hard assets, whether they're infrastructure companies, whether they're companies with that are food businesses, water businesses. We're making sure we've got investments in precious metals. We think the precious metal sector is going to not only continue doing well, which we've seen in the first quarter, but have some great opportunities to produce tremendous wealth over the next couple of years for our investors. And we're going to continue to keep the pedal on the metal there and keep good weightings in that sector also. And then also just keep some optionality in terms of some cash, so that we have some powder dry and we can pound into great opportunities as they emerge in the market. So the bottom line is, look, we continue to go down a road that is not a healthy road financially. Governments are not running their affairs prudently, and that is going to continue to put pressure on investment returns and make it absolutely essential, critical, that we are careful about our investments and where we're putting our money over the long term. And that's exactly what we're doing. So if you have any questions, please email, call, and we'll continue to update you on the state of affairs going forward. Thank you very much. Bye now.